Good afternoon.
Mark, it should be on.
Good afternoon. My name is Marcus Noland. I'm the Executive Vice President and Director of Studies here at the Peterson Institute, and it is our great honor to come together this afternoon to launch a new book on the long-term sustainability of euro area government debt by our colleague Bill Klein. Bill has been a senior fellow at the Peterson Institute since 1981. During a period of leave, he was Deputy Managing Director and Chief Economist of the Institute for International Finance here in Washington. Before joining the Peterson Institute, he was a senior fellow at Brookings, Deputy Director of Development, Trade, and Research in the Office of the Assistant Secretary for International Affairs in the U.S. Treasury Department, and an assistant professor at Princeton. In the book, Managing the Euro Area Debt Crisis, he argues that the policy breakthrough that stabilized the region was the July 2012 decision by the European Central Bank to do whatever it takes to preserve the euro through its program of outright monetary transactions, or OMT, to purchase government bonds as necessary, conditional on adjustment programs. The real methodological innovation of the study, though, is a technique that Bill has developed for assessing the probability distribution of future paths of sovereign debt burden, in which he calculates the covariance across various scenarios of the key macroeconomic variables. His model suggests that Ireland, Portugal, Italy, and Spain may have achieved a sustainable position if they are able to muster the strong and persistent political will to stabilize, to sustain the sizable primary surpluses needed to ensure their future paths to sustain their solvency. Greece is the exception, and whether the future debt relief is necessary is unclear. Looking forward, Bill argues that it will be crucial to ensure that the OMT remains in place, and makes a number of arguments about proposals that have been made of various sorts, which he will go into in his presentation. Now, given the importance of the topic, we have not just one, but two eminent discussants. Willem Bouter is the chief economist of the Citigroup. Prior to his appointment at Citigroup, he was professor of European political economy at the European Institute of the London School of Economics and Political Science. He was a member of the Monetary Policy Committee of the Bank of England, an extraordinarily eminent and important position, as we all know here, and chief economist and special advisor to the president at the European Bank for Reconstruction and Development. He has held academic appointments at Princeton University, as has Bill, University of Bristol, Yale University, and the University of Cambridge. Willem is originally from the Netherlands, but he assures me that he has recovered from yesterday's trauma. Our second discussant is our colleague Angel Ubide, who is a senior fellow here, and also co-director of global economics for D.E. Shaw, a global investment and technology development firm. Prior to this, he worked at Tudor Investment, the International Monetary Fund, and for McKinsey. Angel is originally from Spain, and honestly, I'm not sure if he has recovered from his recent trauma. Anyway, we look forward to these presentations. Afterwards, we will have question and answer. So please, Bill Klein.
Thank you very much, Mark. I first want to say I'm grateful to Willem and to Angel for contributing to today's discussion. I also want to acknowledge the excellent research assistance given by Jared Nolan and Yimei Zhou. And also like to thank several of you who are here today who made comments on earlier drafts. The title of the book is Managing the Euro Area Debt Crisis, and it's meant to convey the judgment that the sovereign debt crisis of the periphery countries has now reached a phase where it should be manageable going forward. The basic reason is the diagnosis that these economies are solvent and do not need debt restructuring with haircuts. Now, although this is the mainstream view at the present, it was much more controversial in mid-2012 when I first published similar results in a working paper on Italy and Spain using the model that I've developed for the study. At the height of the crisis in 2011-12, the outlook was much more dangerous. This figure shows what I think of as the fever chart of the crisis, the path of sovereign risk spreads above German 10-year boons for the periphery. Chart shows the contagion of the crisis from Greece to Ireland and Portugal, and then even to the much larger economies of Italy and Spain. However, it also clearly shows the important turning point at the middle of 2012 when the European Central Bank declared that it would do whatever it takes to preserve the euro and announced the program of outright monetary transactions to purchase government bonds, if necessary, and conditional on adjustment programs. Since then, the spreads on Italian and Spanish government bonds have declined from peaks of 500 to 600 basis points down to a range of 150 basis points, 160. Moreover, both Ireland and Portugal have successfully completed their rescue programs, and both have had successful bond issues. It will be important, nonetheless, for the euro area policymakers to maintain diligence and not become complacent, because there is still a long road ahead that will require sustained fiscal discipline to consolidate the recent gains. There have been intense policy debates on several key issues in the crisis. First, and perhaps foremost, is a debate on whether there has been too much fiscal austerity in response to the debt crisis, with counterproductive results of reducing GDP. Now, it does seem that the so-called fiscal multipliers were higher than the International Monetary Fund had anticipated, and therefore that growth contraction was greater than expected. But the unavoidable reality is that for the debt-stressed periphery, running larger fiscal deficits and borrowing still more money to accumulate still more debt was not a realistic option. Greece, Ireland, Portugal were cut off from the credit markets. The European partners had already made large lending pledges, and a collapse in country commitments to fiscal adjustment would have spooked the markets even more, causing interest rates to surge still higher. Now, in cyclically adjusted terms, the 5 periphery economies have made major fiscal progress, already completing by 2012 about 3/4 of the needed reversal from primary or non-interest deficits to primary surpluses. So the needed pace of adjustment going forward is smaller. In an appendix to Chapter 2, I develop a model in which the welfare equivalent multiplier can actually turn negative under conditions of escalating default risk, because the increase in the probability of a catastrophic default crisis multiplied by its social cost exceeds the gains from increased output when there is a widening of the fiscal deficit from an expansion. In another appendix, I show that even when the multiplier is temporarily high, the impact of a fiscal expansion will only temporarily reduce the debt ratio by boosting the GDP denominator, but that over time, the consequence will be a path of higher debt relative to GDP, a result found in a similar study at the IMF. Now, a second major question has concerned the so-called doom loop between banks and sovereigns. The causation has run in both directions. In Greece, a sovereign collapse wiped out the capital of the banks. As shown in the figure, bank spreads rose in response to rising sovereign spreads. Now, the rising sovereign spreads, more generally, not just in Greece, also boosted risk spreads faced by the banks in other periphery economies. And these banks passed along the higher costs, although only partly in terms of higher interest rates charged to their clients. And the other part, as theory would predict, in the form of credit rationing, contributing as a consequence to financial fragmentation. The main shock to the sovereign from the banks occurred in Ireland, where the socialization of bank losses added 40% of GDP to public debt. The sovereign spread rose in response to rising bank spreads. Now, there's been much concern that future bank losses in the periphery could add still further to public debt, most recently in Portugal. However, my calculations using an IMF-based model relating prospective losses, bank losses, to GDP growth and unemployment find that the large write-offs already taken, such as the 100 billion euros in Spain in 2012, mean that it's unlikely that there are huge hidden losses that in the future could bankrupt the governments. OECD and academic estimates of capital needs are also modest. About 2.5% of GDP capital needs in Italy and Spain for banks, about 3.5% in Ireland and Portugal, according to these estimates. Now, the private sector would cover most of these needs, especially under the tougher bail-in rules of the new banking union. And what would be left in terms of additional government debt would be minor against the benchmarks of 100 to 120% of GDP already in the debt ratios. A third question has been the link between the external imbalances and the sovereign debt crisis. There were large, very large, current account deficits in Greece, Ireland, Portugal, and Spain, and these made the economies vulnerable to a sudden stop liquidity squeeze. The left-hand chart in this figure shows that the sovereign spreads in 2012 were closely related to the size of the current account deficit in 2007-2008. The sudden stop shock was nonetheless less severe than it would have been for emerging markets because there was no currency devaluation, and therefore there was no balance sheet shock raising the domestic currency valuation of foreign obligations relative to domestic currency revenue. Moreover, central bank refinancing operations through the so-called Target 2 mechanism provided liquidity to replace capital outflows. Now, there has been the core question of whether countries can carry out needed competitiveness gains with a single currency. Well, it turns out that the current account deficits have been eliminated. And except for Greece, at least half of the adjustment has occurred on the output stimulating export side instead of on the import side, and even some of the import adjustment would be import substitution instead of demand compression. The process of internal devaluation has helped, particularly in Ireland, where there have been significant wage reductions. Going forward, I do not see that there is a need for large further increases in trade balances. As you see in the right-hand chart, there is no relationship between the spreads as of 2013 and the medium-term expected current account balances for 2012 to 2016. Moreover, if you do regressions of spreads on the net international investment position, there's only a very small, very modest influence. Further, the magnitude of the euro area's combined current account adjustment has not been so far oppressive for the world economy, because it turns out that the increase in the euro area current account has more or less equaled the decrease in the surplus of China plus Japan. Now, a final aspect of the external balance argument is whether Germany has to reflate in order to have the periphery recover. My calculations suggest instead that plausible ranges of increased German demand and inflation would not make a huge difference for the prospects of the periphery. Perhaps the most important policy response of the euro area has been the ECB's outright monetary transactions. In the OMT, the ECB stands ready to purchase government bonds from a country that's under market stress if the country is in an adjustment program. For a while, it seemed that euro bonds might be the answer. But without political union, mutualized debt remains unlikely. Although in the book I do suggest a form of bond insurance. Then there were firewalls set up in the FSF and the ESM. However, they've been held to modest sizes that would be too small to deal with major crises in Italy and Spain. In contrast, the OMT has been so powerful a financial bazooka that it has not even been necessary to fire it in order to calm the markets. The OMT has provided the basis for the ECB to be the effective lender of last resort to stop self-fulfilling prophecies of insolvency from spiraling risk spreads. It will be crucial going forward for the OMT to remain in place. It will also be important that it not be undermined, for example, by court interpretations that the ECB should not be treated on a pari passu basis with private investors. Without pari passu, private investors will fear that ECB seniority will mean larger haircuts for them, undermining confidence. Another salient policy issue is whether Greece is really a special case. Investors lost more than 50 cents on the euro in the Greek debt restructuring. In my view, it should not be necessary to repeat that outcome in any of the other periphery economies. For Greece itself, some additional official sector relief may be needed, but I'll come back to that. But the basic reason is that the debt ratio remains high, and there presumably will be a reputational damage for market perceptions from the restructuring. A related question is whether the euro area would benefit from a formal debt restructuring mechanism. My view is that such a mechanism would be counterproductive. It would set up expectations of future Greek-like restructurings, contradicting the diagnosis that Greece was a special case. It would undermine the OMT by calling into question the key premise of pari passu status for the ECB and private creditors. Finally, I very briefly examined a question of the need for monetary stimulus in the euro area. I suggest that the ECB was slow to reduce policy rates, but I question the magnitude of potential gains from quantitative easing. The essence of QE is to reduce the term premium between long-term and short-term government obligations. But this premium is already relatively low in Germany and France, and there's not as much remaining scope, in my view, for reducing it further as there was in the case of the United States. So with these policy observations as background, let me turn to the core quantitative estimates of my study. The framework for these estimates is a debt sustainability model. Now, the classic test for debt sustainability is that the ratio of public debt to GDP is not on a track that spirals ever upward and out of control. If the debt ratio is along such a path, the country is insolvent. If instead the debt ratio can be kept from rising above its present level, and the country has market access, or especially if the trend is downward, the diagnosis is that the country is solvent. Now, there's a well-known test for this question. The primary surplus needs to be large enough to cover most of the interest so that the proportionate rise in the debt in the numerator is no larger than the proportionate rise from growth and inflation on GDP in the denominator. The formula for this threshold is that the primary surplus as a percent of GDP needs to at least equal the difference between the interest rate and the nominal growth rate. And this difference has to be multiplied by the existing debt ratio to GDP so that a high debt country needs a higher primary surplus than a low debt country. As an example, in this slide I show the averages for Italy in 2014-2020 baselines. It turns out that Italy's high primary surplus, averaging 4.5% of GDP over the next 7 years, is indeed larger than the 2% needed to address the excess of the interest rate over the nominal growth rate. 4.2% for the interest rate, 2.6% for the nominal growth rate. Even taking account of the high debt ratio, an average of 125% in this period. There is a cushion that leaves room for a gradual reduction of the debt ratio. Now, I do argue more generally that in the context of the euro area periphery, the benchmark of 120% of GDP that has become frequently cited in the policy circles does have a meaningful grounding in the numbers. If you take what are plausible growth rates, plausible primary surplus rates, and plausible interest rates under more normal conditions, you come up with sustainability of 120%. Again, illustrating with Italy, I show here the key variables of the scenarios that are considered. My projections involve an accounting consistency framework in which the debt rises by the amount of new borrowing minus amortization. The net increase equals this year's fiscal deficit plus any public costs of bank cleanups and other discovered debt, minus any receipts from privatization. I consider a baseline, an unfavorable, and favorable scenario for each of 5 major variables, with probabilities of 0.3 for the 2 flanking and 0.4 for the central. Sovereign risk spread, the variables of sovereign risk spread, the growth rate, the primary surplus, discovered debt from bank recapitalization or lending to partners, and privatization receipts. The spreads in my baseline are around 200 basis points 2014-15 and 175 basis points thereafter. I have an unfavorable scenario in which I increase the spreads by 150 basis points throughout, and a favorable case in which I reduce them by 50 basis points. As the table shows, baseline growth for Italy is modest, 1.2% annually. I do have 1.7% based on, for the favorable case, based on the 60th percentile in the past 20 years. A high primary surplus is a distinctive feature of Italy's case. Discovered debt isn't bank cleanup in the case of Italy, it's lending to the other periphery economies. There's a big question about privatization. The IMF says there's going to be no income from privatization. The Italian Ministry of Finance says that it will average 1% per year for the next 5 years. That's in my baseline. Now, my method, the method that I developed to come to a probabilistic projection takes explicit account of the likely correlation between favorable and unfavorable scenarios for each variables. And these are not just from the past experience. You have to think through the context of the situation. This is in a default risk situation, so the correlations can be different from business as usual. For example, I say that the primary surplus has a -1 correlation coefficient with privatization. Well, why is that? Well, it takes political effort to privatize, and if there's a lower fiscal gap to close, you're likely to have slippage on the privatization. What these correlations mean is not the algebraic direction of the variable, but whether it's the good case correlated with the good case, which is a +1, or a good case correlated with a bad case, which is a -1. In the case of the growth in the interest rate, in the face of default risk, higher growth will tend to boost confidence and reduce the sovereign spread. So that causes the good case for growth to be positively correlated with the good case for the interest rate. The appendix to Chapter 6 of the book goes through the argumentation for each of these correlations. So if you have 5 key variables and 3 scenarios, there are 243 possible outcomes. If you take account of the probability or of the correlations, then, I'm sorry, you have 243 possible outcomes and you assign a probability to each of these after you take account of the scenario correlations. In the case of Italy, the 75th percentile, high-end unfavorable range, even in that case, the debt ratio declines. In the baseline, it falls considerably further. In the 25th percentile case, it falls even further, but not by a whole lot. So this particular case is one in which the baseline has more downside risk and unfavorable risk than favorable risk. And that's partly because in the favorable privatization scenario, I did not assume much additional privatization because the privatization assumption was already high, and also because privatization is negatively correlated with the primary surplus. Nonetheless, the bottom line, in my view, is that the projections suggest Italy is solvent, so that there's a quantitative underpinning to the return of sovereign risk spreads from their extremes to 2011-12 back to the more comfortable levels at present, even if they're not headed back to near zero levels that really marked the period before the Greek restructuring showed that industrial countries too can default. The quantitative estimates of Chapter 6 present the debt projections. This table summarizes the baseline assumptions, which broadly track the most recent IMF report at each point. I would note that the assumed growth rates are not particularly ambitious, especially for Spain. The primary surpluses are also modest, except for Italy. Now, the bottom line is the projections by 2020 have all four economies with debt ratios in the range of about 100 to 120%. And that's why I think that they are consistent with solvency and considerably lower than the 2013 levels for all except Spain. Now, for Greece, my 2020 baseline projection puts the debt at 127% of GDP. That's a lot lower than the 180% or so in 2013, but still very high. The figure suggests, as the figure shows, my projections are very close to the April WEO projections, the line in dashes. Now, because most of the debt is owed to the official sector, the euro area partners, the interest rates are below market rates. So despite this very high debt ratio, Greece's interest to GDP burden is not much different from some of the other periphery economies. And it's conceivable that the financial markets will focus on that ability to pay the interest and reinstate Greece to market access, especially if it adheres to its fiscal targets. But it's also possible that the official sector will need to grant additional relief to Greece to set the stage for renewed market access later in the decade. Figure also shows the case for Spain, again, which is close to the recent IMF projections. Spain is the only periphery economy converging upward from a low debt level rather than downward from a high level. But the key point is that its debt ratio should plateau at a safe level rather than spiral out of control. The baselines for Ireland, Italy, Portugal all show steady and significant improvement. My baselines for Italy is more favorable than that of the IMF because I include privatization. For Portugal, my baseline is slightly more pessimistic. For Ireland, I'm a bit more optimistic, with about half of the difference attributable to my inclusion of some privatization. This summary figure shows the probability-weighted paths of debt to GDP for the four periphery economies, excluding Greece. It turns out that all four are converging to a range of about 100 to 120% of GDP, with Spain converging upward from lower levels, whereas Italy, Portugal, and especially Ireland are converging downward. So the broad diagnosis of solvency applies to all four of these periphery economies. Now, Greece has virtually all of its borrowing needs already lined up through 2020. And given the low interest on the debt, as I say, it conceivably could begin to re-enter the market thereafter. And indeed, it already re-entered the market for five-year paper earlier this year. So there's a question mark on Greece, but clearly Greece is the closest to insolvency. Now, I do a final stress test. On page 159, I show what happens if the primary surplus does not exceed 2.5% of GDP. That's not very ambitious. The main impact is on Italy, where the debt ratio plateaus at 130% of GDP rather than coming down to 115%. So even in a more politically constrained case, solvency would arguably be maintained because the debt ratio would not be spiraling ever upward, but there would be more vulnerability to adverse shocks. The broad conclusion then is that the euro area has reached a point where the sovereign debt crisis has improved greatly and that the crisis should be manageable going forward. But political will, in my view, is crucial to sustaining the primary surpluses that will be needed. Thank you.
Okay. So what do I do to get visual delights?
It will appear by magic.
Okay. Let's all shout and hold hands. Yes. Okay, very good. It's really a pleasure and honor to be here and to be able to discuss this really interesting and excellent book by Bill. What I like about it especially is that even where I disagree with his conclusions, we can pinpoint exactly why we agree. Because it just is, all the parameters are there. The framework is a common framework. It just is basically disagreement about interest rates, growth rates, and politically sustainable primary surpluses. So it's in other words, it's a discussion that people can make up their minds about using this same framework. Okay, let's go about that. Before I get to that, let me just say briefly that the focus on the question whether the sovereign debt in the euro area periphery is sustainable, or whether there will be further debt restructuring. It is, in my view, highly likely that there will be further debt restructuring, and I also think it is desirable that there will be more debt restructuring than seems likely. That's a separate issue. Now, since Germany, West Germany at the time, defaulted first on its domestic debt in 1948 and then on its external debt in 1953, there has not been a sovereign default in Western Europe until Greece defaulted twice in 2012. If we look at default in the sense of PSI, private sector involvement, then the only other periphery country to have defaulted is Cyprus, right, which had a small technical default on privately held sovereign debt, I think 1 or 2 billion worth, but it should be in there for completeness. If we take a broader view of default and restructuring as including OSI, official sector involvement, then of course Ireland and Portugal have already had sovereign debt restructuring because the terms on their officially held debt, the EFSF debt, the EFSM debt, and whatever else of way of algebra soup they borrow from, that debt has had its interest rate reduced, its perpetuities extended, and so there was no PSI, no private sector involvement, but definitely OSI. Ireland just got another one when the sort of the ECB and the European Commission allowed them to fudge some of the debt that they had incurred as a result of the rescue of Allied Irish and the Bank of Ireland. Now, the debt equation, and Bill is basically the same framework, is that the change in the debt to GDP ratio, little d, is basically the interest rate, real or nominal, doing the nominal bit in the bottom line, real in the top line, minus the growth rate of real GDP. there's a little fudge factor for discrete time, 1 plus the growth rate, which you can ignore, times the standing stock of debt, minus the primary surplus, S as a share of GDP, plus whatever bank recapitalization cost the government incurs, minus privatization receipts. And the nominal interest rate minus the nominal growth rate is in the second expression. These are equivalent. So that's what drives the debt. And you get a solvency expression out of that you can actually write. If you're willing to do a bit of hand waving, and since now we work for a bank, I do a bit of hand waving, interpreting all the symbols now as permanent or long-run average values in the future. So your permanent primary surplus as a share of GDP has to exceed the permanent real interest rate minus the permanent real growth rate plus whatever you have to cough out, the permanent value of the, in the sense of permanent income equivalent of bank recapitalization and privatization. And so that's, you're insolvent and, if your primary surplus, on average in the future as a share of GDP, is less than that. And so the question then politically becomes, is the maximal primary surplus that we can on average sustain in the future large enough to to beat the minimum primary surplus that is required to keep us solvent? And I think in a number of countries in Europe, even now, going forward, the answer is likely to be no. There's nothing uncertain. I think the stochastic analysis is absolutely right. So I will never make statements like country X will default, but I can simply say it's highly likely that country X will not make it and have PSI. Incidentally, in the case of Greece, of course, the public sector held claims on the Greek government are in the process of being turned into zero coupon perpetuities, right? By steady maturity extension and coupon cuts. Basically promises to pay nothing forever. So full face value, zero net present value. And that is, of course, what allowed Greece to issue debt again 5 years at just under 5%, which is extraordinary and slightly mad until you realize that it makes complete sense because de facto the newly issued private debt a few months ago, and in fact the stuff they're doing right now, has been made senior to the officially held claims on the Greek sovereign. And these officially held claims are not just junior to the new private debt, but in fact they're going to disappear. So it makes complete market sense. If I'd been able to get my hands on that newly issued Greek debt, I probably would have done so. It's better than what I get in the bank. Okay. Now, my point is the periphery sovereigns will not spend much more rescuing their banks and other systemically important financial institutions. I reached the same conclusion as Bill, but for a different reason. I think the losses that are likely to be uncovered by the comprehensive assessment, where the AQR, asset quality review and stress test, are going to be large. There are a lot of bad banks in Europe, but they will be overwhelmingly met either by liquidation in the case of systemically unimportant banks or by bail-ins of unsecured creditors. Basically, the BRRD, the Banking Recovery and Resolution Directive, which is not meant to kick in until 2016, is being brought forward to be ready in October this year when the scorecard is held up. Germany has, the cabinet has approved of this, and the parliament will no doubt follow. The BRD requires at least 8% of the balance sheet bail-in. And that's, on average at any rate, sufficient for that. I mean, there is still roughly 30 trillion worth of balance sheet in the MFI sector in the euro area, so 8% should do it. My estimate of the likely losses, if this AQR stress test is at all honest, is somewhat larger than Bill's, incidentally. It's about 3% of the balance sheet, which would mean 9% of GDP, because the balance sheet is roughly 3 times GDP, annual GDP that is. Now, privatization will not yield any revenues. right? Historically, unless you have natural resources to sell, right? Or maybe telco, right? You lose money on privatizations, right? The great example of this is the Treuhandanstalt, which had 8,500 state-owned enterprises in Germany in 1990-1994, massive real property as well, land, and ended up, when it wound up, with cumulative losses of 260 to 270 billion. So don't expect much, if anything, from privatizations, right? Because the Italian government doesn't have a net, and even where there are valuable assets, like some of the state-owned, well-managed state enterprises, of course the net present, they're unlikely to get much more than the net present value of the income the government would get from it anyway. So it's a liquidity issue at most, rather than a secular issue. Now, the other reason I get different results from Bill, that I believe that current interest rates on the sovereign debt of the periphery countries are insanely low and will not remain that way. It's a combination of an extraordinarily low, I think fundamentally warranted probably, low safe rate, think of it as boons, right? And a bubble-driven decline in spreads. And both, I think, will normalize and therefore make the test harder to meet. Despite the presence of OMT, remember OMT is there to rescue the euro and to prevent disorderly sovereign defaults. It is not meant to prevent sovereign debt restructuring of insolvent governments. Right? They don't have the resources to do that, at least not in a non-inflationary way. Right? The net present value of future non-inflationary revenue of the euro system is a mere 3 trillion, which is not enough to deal with the European sovereign debt problem, in my view. I want to take the chart that Bill showed you about risk spreads in the euro area, but take it back a few more to show you just for how long markets can be insanely irrational. Right? Bill started in 2008 or thereabouts, when we see the big spike and then the return to abnormal. But what I want you to look at is what happened for Spain, Ireland, Italy, and Portugal, never mind Cyprus, between when they joined the Eurozone, 1999, and 2008, that is, to my count, 9 years, the spread never went, with bonds, never went above 25 basis points. And Greece, which joined in 2001, likewise, for 7 years, the market thought this was basically bonds. Right? So markets can remain irrational for longer than we can remain solvent, or longer than we can remain take positions against the irrationality, because our risk officers won't let us. And at the moment we are in a version of this wild irrationality, where borderline insolvent sovereigns are priced 150 basis points above bonds. So I expect that I believe we are not in secular stagnation in the euro area. We are at risk of it, right? But I expect that enough will be done to escape from it, and that therefore a return of the risk-free real rate from negative levels currently to positive levels of 1 to 1.5% is likely, right, over the next 4 or 5 years going forward. Add on top of that an inflation target of 2%, right, for the euro area, and the neutral rate for the ECB would be for the refi rate would be about 3.5%, right? Add to that a term premium, and you get bonds like 10 years of say 4.5%, and add on to that then the reasonable risk premia, not less than say 150, 200 basis points for the periphery countries, and you have something that gets you to 5.5 to 6%. And I think that the average cost of market borrowing for these countries will find themselves not below 5% once the markets stop sniffing glue and start pricing risk again. It's not just for the euro area sovereigns, right? It's for the euro area banks, that we do have this problem, and for American corporate credit. Okay, but here they are. This is just a historical record here. Nominal GDP growth, as you can see, even if we have currently very low effective nominal rates on these debts, on average, 2.5% to 3% for the Italies of this world. Nominal GDP growth rates are, of course, still well below that. And unless the ECB wakes up and smells the roses and generates 2% inflation for the euro area as a whole, no periphery sovereign is, I think, sustainable. Because the less than 1% euro area average, right, means negative inflation, if we shall see, for most periphery countries. And in my view, a 3.5% to 4% nominal GDP growth rate, on average, is necessary for each of these countries to make it, to be sustainable, given my assumptions about interest rates. And the maximum politically feasible primary surpluses, which are definitely not in the 5% range. I think my range is sort of 2 to 4% depending on the country, and 4 is really challenging. So these are the average nominal GDP growth rates since for this whole period for these countries, and see that the average number is achieved by Ireland and Spain, and Cyprus indeed, but even Italy doesn't get anywhere near it over the entire period, not just the last few years. Real GDP growth rates, of course, abominable. Right? My estimate, and this is the average over the period here given for these countries, my estimates, for instance, of Italian potential output growth, we have a cyclical recession possible, is 0.3%. Sorry, my estimate of Italian potential output growth going forward without radical reform is 0. My team are wild optimists, right? They say it's 0.5%. I give you 0.5%, right? If I give you 0.5% and 2% inflation in Italy, they're still borderline insolvent, right? And so we need radical reform in Italy. Now, the good news is that well, I thought Italy was a hopeless case because I did not see the political will to do the supply side reforms necessary to get growth up to 1.5% even, right, over the next 20 years or so. It is, well, the European parliamentary elections were a disaster, mostly, right? No, you have 3 neo-Nazi parties in the European Parliament, right? This in the continent that has form on these things, really worrying. But in Italy, common sense broke out. 42% of the people voted for reform-minded, pro-Euro, pro-European. So it is possible again. But there has to be a political victory. Right? They have to have the political reforms, electoral reforms, that makes it possible to have an election that produces a viable majority that is not dependent for its survival on anybody whose first name is either Beppo or Silvio, right? And then they have to legislate the reforms, and then they have to implement them. It is a huge challenge. It's possible, I think, now, but it is still, I think, quite unlikely that they'll manage. The trend growth rate for Spain, I think, is the only area where I'm more optimistic than Bill. I think Spain can grow faster than 0.8, right? Especially since their cyclical recovery will look like a secular expansion. Okay, here we go. Here's the GDP deflator. You can see negative inflation rates for almost the entire periphery, not for Italy actually this last year, in making it basically impossible to achieve solvency unless the ECB wakes up and smells the roses. Okay, general government debt, I think, will not turn for any of these countries anytime soon, except for Ireland, which has real growth potential in the 2.5 range, which therefore should put it with the ECB contributing on the inflation front, and its real competitiveness adjustment having been completed more or less, should put it in the sustainable camp. So Spain is a likely sustainable candidate in my view, provided they do additional reforms and we don't have Catalan exit, right? Exit from Catalonia, which is in turn dependent on there not being Scottish exit from the UK on the 18th of September, so keep your fingers crossed. Greece, I think it's hopeless. We know that. Portugal, I think it would take a minor, well, not quite. Here we have the Portugal, it needs the ECB to do its job. No fiscal S&M, very important. Go gradual, right? Very significant further structural reform and a well-behaved constitutional court. Possible, but not likely. And then Italy, ECB, no fiscal S&M, heroic structural reform, and Cyprus, no further bank recapitalization outlays, and successful transformation to post-tax haven money laundering economy, which won't be easy. And then Greece, sovereign, well, you guys, a miracle. Okay. Finally, well, I'll leave it here. I've talked too much already. But read it and read.
Well, thank you. While the, the slides are put up, let me say that we in Spain play football in a much more discreet, efficient, and stylistic way than the Dutch these days. So I'm going to entertain you less than Willem. I want to thank you, Bill, for having given me the opportunity to comment on this. I've been part of the study group. I've been part of the review process, and I can tell all of you that you should read the book, because there is much more in the book than what he showed in the slides, and you can learn a lot of things about what happened in the euro area in the last few years. Let me go straight. You already know that we are running a little bit late. Let me go straight to the content. There are a few things where I agree with Bill's assessment of the euro area. The first one is that essentially this crisis was to a large extent self-inflicted. And I'm paraphrasing him. He doesn't say this in the book. But essentially, when you tell the world that you want some countries to default and you are trying to push some countries out, then what you get is the market price in default and price in exit. It's rational, right? When you then tell them, well, I was kidding, then they say, all right, then I'm no longer going to price exit and I'm no longer going to price default. And that's what happened when OMT was announced and when Germany finally declared in public that Greece was going to be allowed to stay in the euro area. Now, of course, it means that the euro area is solvent. Now, solvency is in the eyes of the beholder, right? It's a question of willingness to pay. It's not a question of ability to pay. And so it all depends on the policy mix. It depends on whatever you want to do with your policies. Remember that there is no threshold on debt to GDP. Solvency depends on the funding situation. And so it is a question of what kind of policies are you going to put in place. I agree that Greece needs further debt relief, but as the previous speaker have said, we already know there is going to be OSI, so I don't need to dwell on that. And let me just say that I agree with Bill that thinking about preemptive restructuring is a bad idea. And this links, if you want, to the current debate at the IMF. But just imagine what would have happened to Portugal 2 or 3 years ago if the discussions that the IMF is having these days had already been policy and the fund had forced Portugal to reschedule as a condition for the program that was given to Portugal 2 or 3 years ago. I can only imagine the kind of contagion that would have generated into several other countries in Europe and the kind of situation we would have had to deal with. So these are the places where I agree. Let me go to the disagreements. There are a few. I think Bill takes the ECB as given, and I disagree with that. I don't think central banks should do conditionality. Moral hazard is not in the mandate of a central bank. What a central bank has to do is to set policy so that financial conditions and monetary conditions are right for the country. A key reason why we ended up where we ended up is because from the very beginning, the European Central Bank decided to put conditionality at the heart of its monetary policy decisions. It's debatable, and I think, having seen what I have seen, I disagree with that. I also think that the policy mix that was put in place in the euro area, the sequencing of the policy mix was wrong. You know, when you are in a situation like this one, you first do the easing, then you do the fiscal tightening. We have seen that in the US. We have seen part of that in the UK. I will show you a slide later on that tells you what the difference of this is. There was a choice, right? There was a moment in which Merkel and Sarkozy had to decide whether the banking crisis was going to be mutualized or coordinated. They decided to coordinate the management of the banking crisis, not to mutualize the management of the banking crisis. That moment, they generated the link between banks and sovereigns. That was a decision, right? 2008, 2009, they could have set up a European fund for the resolution of the banking crisis, and we would have had a very different picture. But that was a choice. So let's remember, there were many choices that were made along the way that could have been different. I also disagree about the fact, and I think Willem also said this, and I also disagree with him, that spreads have to increase. I don't think you can have a functioning monetary union without a risk-free asset. And you don't have a risk-free asset today in the euro area. And if we continue with this situation where different countries have different levels of spreads of the order of magnitude that we have today, it's going to be very difficult to make the monetary union function. So we need Eurobonds. And remember, Eurobonds are not about transfers. Eurobonds are about financial stability. You need banks to be able to hold a risk-free asset that doesn't link it directly to what the country is doing. You need a risk-free asset that the ECB can buy, so it can freely do quantitative easing without worrying about which bond of which country is buying. And then you want to have a system where fiscal policy can be counter-cyclical. Otherwise, the system simply doesn't work. So, in case you have forgotten, this is what we have, right? This is the picture of the euro area crisis. Okay? It's going to be a lost decade if we are lucky. And I'm saying if we are lucky because I have no idea when the next recession will be. So the next recession, whenever it happens, is probably going to hit with a level of GDP that is not going to be terribly different from 2006. That's what we have. And again, could have been different, but this is the way it is. Now, this explains everything, right? It's the same chart you have seen before, but in real terms. Now, I want you to focus on two things. One is the way the evolution of Spain, that it breaks around 2010. Italy does the same thing. Portugal, Greece goes higher. Look at the thick, light blue line. That's Germany. Okay? It follows the US. It follows the UK. If you didn't know, you would think that Germany had quantitative easing based on that. Because the evolution of 10-year real rates follow exactly the evolution of the US and the UK, exactly the countries where quantitative easing was done. So for all practical purposes, the monetary policy stance that Germany had and other countries was similar to one of quantitative easing. And I think that's very important in order to tell the narrative of what has happened in the euro area and why some countries are doing better or worse than others. Now, Paul de Groof put up a piece last week on Vox EU that does something similar to this. That is, well, maybe that explains the difference between Spain and the UK in terms of the debt to GDP ratio profile. And I just threw Germany there, just for comparison. The line is when spreads start to go silly. The fiscal consolidation in terms of the reduction in the structural deficit, it's bigger in Spain than in the UK or in Germany. But look what happens to the debt to GDP ratio. It increases, it accelerates in Spain, it sort of is stable in UK and in Germany. So some things are the way they are because of policy choices that were taken. So let me just continue with a couple of charts which basically try to convey the message. It's tough. Let's just not make it impossible for the countries, okay? So don't set them up for failure. The first one, this is an old favorite of mine, with apologies to the ECB representatives, but the policy stance is simply too tight. You need to generate growth in order to be able to do fiscal consolidation and in order to be able to put reforms in place. If you calculate any kind of policy rule, it tells you that the interest rate today should be very negative. Now, of course, I know that interest rates cannot go negative at the policy rate, but there are other things that can be done in order to have the right policy stance in place. Now, let me look at the long run, and this links a little bit to the equations that Bill and Willem have put in there. So I was curious to know whether the markets are pricing the spreads for the long run. So I look at the forward curves. Let me walk you through the table for 1 second. So the first row shows the 5-year and the 10-year rates for Germany, Spain, and Italy. The columns show you the spot price, or today's price, the same yield 2 years forward, the same yield 5 years forward, okay? So what you see is that the markets today are pricing 10-year rates in Spain, for example, at around 2.8. Those are swap rates, but around 4.3% in 5 years, at around 4.6% in 5 years. For Germany, 2.4. So essentially what the market is telling you today is that the spread between Spain and Germany for the 10-year rate in 5 years is going to be 1.9, and for Italy is going to be 2.2. Essentially no improvement whatsoever. Now, if you do it in real terms, I've taken the measures from inflation swaps at the 5-year and the 10-year rate. We go down, we can calculate the 5-year real rate, the 10-year real rate forward. And that tells you that in 5-year time, markets are expecting Spain to have a 2% real 10-year interest rate, and for Italy around 2.3. Now, what's potential growth in these countries? I don't know. But I took the WIO forecast for 2019, and I assumed that that was a very good approximation to potential growth. 1.3 for Germany, 1.3 for Spain, 0.9 for Italy. Now, look at the R minus G. That was critical in the debt equation that Bill and Willem were showing. It's very beneficial for Germany, minus 1.2. It's positive for Spain, it's positive for Italy. Now, with 100% debt to GDP ratio, 0.7 for Spain means that the primary surplus that stabilizes the debt ratio has to be 0.7 more. And for Italy, because the debt is above 100%, it means it's 1.4 times a factor. So this is what the markets are pricing today. The next time you think that interest rates in Spain and Italy are too low, think about this table. And think about how complicated it's going to make it from a socially sustainable standpoint to hold the primary surplus that they need to hold, and whether there is something that can be done about it, right? So let me conclude. I don't think this will surprise most of you. I think the euro area is weaker today than it was before the crisis. Some things have been done, but on net, the starting point is weaker than it was in the previous cycle. There is no question about solvency if the right policies are put in place. We need demand policies to prevent a deterioration of potential growth. This is a debate that is not really happening in Europe, and it should. It needs the right monetary policy stance, and it needs Eurobonds. Now, notice I didn't put reforms, because I have decided not to use the word reforms anymore. It's an empty word that means nothing in itself, and is really thrown around in order not to talk about other things. So, of course, countries need to push potential growth. Everybody needs. The US, the UK, Malaysia, every country in the world. But this is also needed. And if we only talk about supply, we are not going to do demand. And I haven't put a bullet point for banking union, because banking union is secondary if we can get those things done. Because yes, we already have a supervisory mechanism that is going to do probably supervision a little bit better than before. What matters is to have a fiscal backstop. So let me conclude with the last point. How do we make all of this happen when what is good for the euro area doesn't necessarily coincide with what's good for the political establishment in Germany? That's what leaders in the euro area need to deal with. And I think that's where Bill's book is going to be very useful and very influential. Thank you. Sorry, I couldn't go faster.
Sure.
That's okay. That's okay. Well, we have a limited amount of time, and we have three people who have a lot to say. So what I suggest we do is we gather a few questions, and then we give the speakers a chance to respond, and Bill a chance to respond to any comments that Willem and Angel made during their presentations before adjourning. So there is a roving microphone here in the front. There is a standing microphone in the back. And so if you'd like to raise a question, either go back to the back microphone or raise your hand. Yes, please. And please identify yourself and your affiliation, just because everyone does not know everyone else.
Manmohan Kumar was with the IMF. It's a wonderful book, Bill. I really enjoyed reading it. In the key issue, I mean, all of you have actually sort of summarized, focused on the primary surplus and R minus G. One question, though, is to what extent this high level of indebtedness itself would affect G also. We talked about R. Now, we all know the controversies which have raged over the last 3-4 years on the relationship between debt and growth rates. So perhaps something on that. And Anjal, you mentioned that you don't want to talk about reforms. It seems to me that that is actually a crucial element in terms of the story which Bill Klein is saying. And I don't know, Willem, to what extent you are sort of discounting the ability of the governments to undertake the reforms, or perhaps they can undertake them, but they will not yield the results which would be necessary to make that sustainable.
Mm-hmm. Any other questions? Yes, please.
My question, Mike Massetti of the NewsHour, my question is a brief follow-up on that. There have been just a couple of references here to politics. And the question is, you mentioned the not very good outcome in the Euro parliamentary elections. This may be a little out of your bailiwick, but is there going to be enough political strength to keep on this path? I mean, they're already the pressure seems to be very much in the other direction.
Very good. Do we have any other questions? It's like an auction, and I see Jacob raising his hand slightly, but not. Okay, well, we have a limited amount of time, and those were actually very broad questions. So why don't we do this? Why don't I turn to Bill and see if he would like to make responses both to those questions and to the comments raised by Willem and Angel, and then Willem and Angel may respond to the questions as well.
Right. On a question of whether a high debt ratio itself causes a slower growth rate, I mean, I think it's true that you've got the crowding out phenomenon. Often you've had crises associated with higher debt ratios. But my sense is that the kinds of growth rates that are assumed in the projections I've made are really quite modest. As Willem said, I've got a really low growth rate for Spain. That's just because that's what the fund has been using. So I don't think it materially undermines the projections and the conclusion. And I think it's right. I mean, I've got, on the politics and on the reform, I have sort of a disclaimer in chapter 1, which says that this book is not really about the political, the politics and reform, but clearly the reform is important to growth. And on the question of whether this is sustainable politically, I'm not the expert, but my impression is that the whole experience has been radical enough that there has been I mean, certainly in Greece, there's been a radical shake-up of the old way of doing things. And I have the impression the same is true in Italy. So, I mean, you saw, you can get structural changes after the trauma of a debt crisis that wouldn't have been politically possible before. I think we saw that in the Latin American crisis, but others probably have more informed views on the political sustainability. I agree, that is a crucial question. On some of the specific questions that Willem and Angel raised, let me first say that Willem seems to say that unless the ECB gets 2% inflation, that the whole thing is going to come crashing down. I don't see the logic of that when you factor in the fact that if they don't get the 2% inflation, your Bund rate's going to be lower. So with the same spread, risk spreads, you're not going to have the kind of real burden that would be implied if the nominal interest rate remained unchanged, but the inflation rate were not as high as anticipated. I've got the Bund rate going to an average of 3.5% over this period, for the whole period, 14 to 20. If the ECB did not make its target, then presumably that would be lower. So that's an offsetting factor. Willem questioned whether you can save anything for privatization. Well, I mean, the Italian Ministry of Finance is not. It is noted for being pretty savvy and having very good analysts. And when they publish that they can make 1% of GDP for 5 years through privatization, I think that they would not make the error of saying, oh, by the way, we're leaving out the fact that we're going to throw thousands of people on the street and this is going to cost. I mean, I think their privatization is somewhat specific. It has to do with doing some sort of, securitized ownership of stuff, to public buildings that are currently being rented and so forth. I don't know the details, but my impression is that Willem's generalization about the privatization may be too negative in terms of what Italy can do. Coming back to the 2%, Willem, at one point on his slides, he says that Ireland is insolvent if the ECB doesn't get 2%. Well, I don't see those numbers. I mean, Ireland's debt ratio is going to come down to less than 100% in the probability weighted. And let's say that you've got even an extra point on that with no change in the interest rate. Over 7 years, you're going to boost it to 105. You're not talking about boosting it to 150. So I'm skeptical about that. The chart that Willem uses to illustrate market insanity, which is that the spreads fell and then they revived. Sorry, I'm going on, but this is important. To me, the whole key is to reestablish and reconfirm the paradigm that existed in the post-war period, which is that industrial countries do not default on their public debt. And the spreads that you observed before the euro were all interest rate differentials associated with different inflation expectations and nothing to do with sovereign spread, very little to do with sovereign spreads. So I think that the international community should be engaged in trying to reestablish the central paradigm that industrial countries do not default. And in the normal state of events, the sovereign spread is zero. On Angel, Eurobonds, sure, they'd be great. I'm surprised that Angel thinks that they are politically as feasible as he seems to think. I would welcome that, but I'd be surprised. On the 220 basis points 5 years out as a spread, if that's what it is, I don't see that as much of a problem. Again, I could put in my model 220 instead of 175. It would make very little difference to my declining spreads, my declining debt ratios. Thanks.
Okay. Just on the inflation point, the average maturity, I think, of the sovereign debt in the periphery is just over 6 years. So there's quite a bit that you can do in terms of reducing or raising the real interest rate by varying the inflation rate. Surely, a newly issued debt, you'd assume that Fisher lives, right? But there is, you'd have certainly until 2020 a lot of pain. I do believe that it's urgent that Europe, euro area, establish a sovereign debt restructuring mechanism, not just to deal with the overhang, but with the likely future recurrence of the fiscal unsustainability that that contributed to this crisis. I do not believe that the institutional mechanisms, two-pack, six-pack, two-pack Amaru, as far as I know, has been put in place to prevent this. The fact that in sovereigns in advanced industrial countries do not default was the product of an extraordinary and unique historical configuration of post-World War II factors that is not going to be repeated. Remember, we ended World War II in most industrial countries with massive debt, right? Britain, I think 246% of GDP, and got it down to 29, I think, by 74. Now, what's different then, and why can't we say, no debt default is credible? First, the legitimacy of the debt was rather different. It makes a difference whether the debt has been incurred as a result of an external conflict against a common enemy than as a result of a massive internal screw-up, right? The 3 decades of post-World War II growth, especially in Europe, were unprecedented. Not only did they have great demographics, we had post-war reconstruction and recovery from the Great Depression and reglobalization after decades of autarky. So it's not going to come back. There was a greater tolerance for inflation, and there was a willingness to use financial repression. I think financial repression may make a comeback, but the other factors aren't ready. So I think we have to be prepared for a world in which sovereigns will get themselves, even sovereigns that are currently not in trouble, into unsustainable conditions, and an orderly restructuring is necessary. If Portugal had been told by the IMF to, what did they call it? Reprofile, I think is the word. It's another euphemism. Right? To reprofile its debt, would there have been contagion? Well, if it had been told to do so after the OMT was put in place, no. Right? Contagion is counteracted by an effective lender of last resort. The only problem I have with the OMT is, of course, that it could still be shot, though it's unlikely politically, by the German Constitutional Court. Right? That says 6 of the 8 members have said we really hate it. Right? And especially we hate the fact that there's no seniority. Anyway, for the ECB, we hate the fact that it is selective rather than unbiased, and we just hate it. Yes. Now the politics. I think that I speak as one here who has an impressive track record of getting the politics wrong, right? I predicted not that long ago that Greece would walk out, wouldn't be forced out, would walk out, tragically, out of the euro area, because I thought that no country, no government could survive a 25% decline in GDP and an increase in youth unemployment of 50%. There would be blood in the streets that would bring down the government, result in a general election that would start as a referendum on austerity and turn into a referendum on the euro. So that was and the first part didn't happen. The government never fell. Right? There was no blood in the streets. At least no significant amounts of blood. Why is that? Well, partly because of the safety valve of migration. Revolutions are made by the young, and the young, the best educated young in Greece, went to Germany, and then the bank of mommy and daddy helped also. Right, and the fact that the demographics were rather different from Egypt's Mubarak's Egypt. In other words, the majority of the population is old, and the old don't demonstrate. They play lacrosse, or no, they watch lacrosse. So I do not believe that it is likely that we will see significant reform, because if we had going to see any, we would have seen some already. Greece has had massive austerity, unhealthy doses of austerity, but very little, negligible, in fact, structural reform on the supply side of the economy, labor markets, opening the professions, service sector, deregulation of utilities and all that. The only country that has had significant structural reform is Spain, and to a lesser extent, Portugal. And even that is not enough, in my view. Will we have more? I don't think so. Greece has made it clear that they can play a long game with the creditors, and they can procrastinate on reforms as long as it takes. So it is possible that Mr. Renzi will succeed, but it would take in getting reforms that change the potential output growth rate in Italy to say 1.5%. Possible, but I think unlikely, because I've seen nothing yet in the willingness of the unions to countenance the end of permanent contracts. I've seen nothing even outside the periphery. Countries like France, which is really a periphery country in waiting, that reform is likely. So I hope I'm wrong, but since I have indeed very modest expectations of reform, I think more than a cyclical recovery and a little bit of extra in countries that have shown themselves capable of reform, like Spain, is the best I can hope for.
So 2 quick points. Now, when a country has a high level of debt, the way I think about it is that the neutral interest rate is lower. It essentially means that monetary policy, ceteris paribus, has to be easier. And I think that's what I was trying to say a little bit with my slides, and I think that's where this is going. Yes, the debt is high in the public and in the private sector, and that's going to mean that in order to generate some growth, monetary policy is going to have to be easier for longer. And we are seeing it probably now, why, if inflation is very close to zero, it's because monetary policy was too tight. And if inflation now is seen as not rebounding beyond 1% for the next several years, it's because monetary policy is still seen to be too tight. And that's what I disagree with a lot of people in that, rates are in bubbly territory or anything like that. Monetary policy is where it's supposed to be. On reforms, I didn't mean to say you don't do reforms. What I meant to say is that you cannot do only reforms. There are many different types of reforms, and what you need is a package. You need a package where you boost demand, where you do the reforms, where you have the right set of policies, and then things can work. We are seeing it in Japan, and I think it's a very good example. Now, the problem with reforms is that reforms don't solve the business cycle. There is a key factor for a country to export more or less than another. That is the firm size. It's not even the level of competitiveness. You cannot change the size of firms overnight. That's a problem that Italy has, it's a problem that Spain has to some extent, and many others. There are many things that can be done, but will kick in the next cycle, not in this one. Mm-hmm. And that's what I'm trying to say with, let's stop using reforms as a wild card that you use when you don't want to talk about something else. That's it.
Thank you very much. Well, we've kept you a few minutes late, and I'm going to keep you 1 more minute late. Unfortunately, I'm a bad marketeer. I was told that I'm supposed to say the title of the book 3 times, and I'm supposed to hold the book up. Now, I said the name of the book. I forgot to take it with me at the start. I did say the title, however. I should have held it up and said the title, Managing the Euro Area Debt Crisis, at the outset of this segment. I'm certainly going to hold it up and say Managing the Euro Area Debt Crisis at the closure, and thus fulfilling my obligation. I would like to invite you to join me in thanking our author Bill Klein and our discussants Wilhelm Bauder and Angel Abide, and I declare the meeting adjourned. Thank you.
Okay, thanks, Bill.